Big inflows continuing into money market and short-term treasury ETFs. Investors are loving these 5% yields. You can't get them to stop talking about it. They seem very happy to stay in their 5% treasury yields. But now we've been seeing inflows into short-term investment grade corporate bonds recently. You've got this ultra-short income ETF, JPST, that's getting inflows. I'm a little puzzled about this. What's the appeal of corporates, even short-term corporates, over treasuries? Different risk ratio here.
Yeah, well, when you look at kind of peak cash levels like this, it tends to be the worst performing asset class once you stretch out over time because everything else kind of does better. And so the ultra short space is actually really interesting right now. You can do what we call step out of cash, and you're able to incorporate with an investment grade that's now, our PM was emailing me over the weekend, he's buying paper 5.8, 6.2%. Your SEC yield on JPST right now is 5.38%. That's a nice step out of cash right now versus like the ag, for example, Bob. Ag, you're getting 108% of the yield with only 10% of the duration. And so that's actually a pretty attractive place to kind of hang out in these markets.
And of course, ag is the biggest bond ETF out there. Although, wait, no, Vanguard Total Bond, I think, is bigger, right, Todd? Vanguard Total Bond is bigger than ag.
They're neck and neck around 90, low 90s. I'm waiting for one of them to hit 100 billion, actually.
Yeah, that'd be big
for the first
big story. Anyhow, his point is ag is sort of the whole bond market, essentially.
Right.
But you've got 5.3% on this JPST. Investment grade debt, but the risks are higher. This is what I don't get. Corporate debt has higher risk than government debt, right? You all know that. So what's the advantage of having corporates
got higher credit quality
treasuries
than the U.S. government right now? We're only taking on 6-month duration, and so we've got it nice and tight in there. So you've got very attractive credit quality. We've got an active manager that's individually selecting each of the bonds that are going into the portfolio, which I think, particularly on the fixed income side, is a very differentiated proposition. And this product's got a ton of track record. It's been out for over 5 years. It's the second largest active ETF in the world. So we think JPST is a great place to be looking right now.
Boy, what a surprise. He likes his product. Is this a permanent change in consumer investing behavior? I'm a little worried about this. Our bond funds, you people love these things. Are they going to pose serious competition for investor dollars? I mean, they haven't for decades, and yet everyone keeps messaging me, hey, Bob, we're happy at our 5% yield, 2% real yield. We don't care about the stock market.
As long as you're in this higher for longer environment, this is candy, especially after not having it for 10 plus years during the QE era. You now just put a bowl of M&Ms in front of a child who can get that 5%. I think that's the analogy I like to use. I also think a big understatement is that when you go out on the curve, you're getting equity-like volatility in a bond product, right? TLT has the same standard deviation as the S&P 500 roughly right now. So I think that's why you're seeing all this money go to money market funds or short duration products.
TLT like is the 20-plus year bond.
Right.
Those of you who don't understand his clipped way of speaking English.
Duration makes sense when the Fed is done hiking in anticipation of cuts. But if no cuts are coming, I don't think you want that volatility. It's not fun to sit in. I'd rather be in that short duration treasury or corporate.
And what about the old pitch? Oh, active management. Have you heard this story before? Active management can move a lot quicker. We've heard, here we go, active management. So
active management, I think, is much more comfortable in a bond wrapper, right, than an equity wrapper. Beating the S&P 500 is tough enough. Beating the ag is different because the ag doesn't have high yield in it, I believe, or it's a limited amount of high yield. So there's more opportunities to outperform when you're active, and especially going across the whole duration spectrum.
Yeah.
Bob, you'll like this. We think of active management versus passive management as black and white TV and color TV, and it's exactly to the point that was just made. A passive index is just going to give you just that. It's the duration of the index. There's no security selection. You're going to drift with duration, whereas active management can pull in not only...
Do you agree with his point that active is better served in a bond wrapper than in an equities wrapper?
I think active management on the fixed income side is a very compelling story, particularly given the way that passive fixed income and benchmarks are constructed.
So that's a yes?
That's a yes. That active management.
I'm trying to get a JP Morgan guy to admit that bond funds are better in an active wrapper.
Well, the reason I answer it that way is because I want to make sure that we're framing it the right way. When we're saying versus the field, I think that's a difficult thing to say. I think good active management can absolutely provide a tremendous amount of value. We just to give you our bona fides, we've got over 1,000 active managers. We spend $400 million a year on research. We're putting good active management into this, and it depends on the outcome that you're trying to deliver, right? So we just launched a product last week. I know you make fun of me for launching products, but we're doing this on behalf of investors. We're listening to investors. What do they want to see in the marketplace? So we launched hedged equity laddered overlay. The ticker, wait for it, is HELO, pronounced hello. So we've got cardboard cutouts of Adele around the office because she's got a great song, Hello from the Other Side, right? And this is designed to give you 2/3 the upside of the S&P with only half the volatility. Maybe an attractive product for the markets, like you're saying. Maybe we grind to the end of the year a little bit here, and this is a way to stay invested for the long run.
He just sold us his new product. Hello, HELO.
Hello.
You got it in. Very good. He's so media trained, it's annoying. It really is. Now, you've been around a long time. You have any thoughts on this Treasury craziness? I mean, their point is if you think inflation is going to cool off this quarter, the risk reward in Treasuries is pretty good right now, right?
There are opportunities, but it doesn't have to be active per se. Rules-based strategies that do things that aren't exactly the same as the index can add value. For us, we have an ETF ticker IGHG. It's investment grade interest rate hedged corporate bonds. What's cool about it is it takes that spread and staples it to Fed funds. In effect, you're actually getting about 6.5% yield staying in corporates, but you have zero Treasury interest rate risk. You can do that in an ETF. It used to be called credit arb. You can do it in an index. So it doesn't have to be active in the capital A sense.
Does it bother you that these ETF products are getting more and more complicated? I used to have a hard time explaining covered call strategies. Now I got to explain even more complicated products.
Those are the hedged interest rate products are fascinating to me. They have done phenomenal since we've had liftoff of the interest rate cycle. But to your point, it's a little bit more complicated than a simple Treasury ETF. But I do agree with Simeon that they've done fantastic. They're a great way to hedge out the duration risk for now until we see cuts whenever that comes.